Hi friends, on 25th November 2024, NSE launched a new index called Nifty India Railways PSU. Now you may say that, Rahul, what is the big deal about this index? This is a very timely launch of a railways index because this is going to be the first index that is going to track the performance of railways PSU companies that have been operating in the railway sector. Now just to refresh ourselves on the railways story, back in 2014 when Modi government came into power first time, the railways capex allocation was only 28,000 crore. This is the number I have taken from government website. Look at in 2024-25, the capex budget went to 2,62,000 crores. And if I do some maths, in the last 10 years, the growth in the capex for railways has been at around 25% CAGR. This is a phenomenal growth of the capex injection into a particular sector by Indian government, maybe in decades. Tell me any sector where you have seen such high growth of capex injection by Indian government. I don't think you will find any sector that has seen such a humongous growth. Especially if you have a look at this chart, you will see the capex injection has been huge in the last 5 years. Also, it was recently in the media that budget 2025, we might see around 15 to 20% of increase in capex in railways, and this number might exceed 3 lakh crores if I were to believe these media news. Now, I'm recording this video much before the budget is announced, so I do not know what the number will be, what the budget allocation will be, but the point here is that Indian Railways growth story will continue for at least next 4 to 5 years is what we can clearly see here. So in this video, what I really want to do is speak about this new index that has been launched by NSE very recently. Extremely important for investors to understand this index. And secondly, I'm also going to pick up 2 to 3 stocks depending on how much time this video permits me. I'm going to give you data backed, totally unbiased, latest and greatest in those 2 or 3 railway stocks. So this video is going to be super interesting, full of knowledge, full of learning in terms of what is happening in railways. If you don't know me, my name is Rahul Jain. I'm a full-time investor and a content creator. I also post in-depth analysis almost on a daily basis on my YouTube member community. If you're not yet a member, consider subscribing and becoming a member for YouTube community. You are going to gain a lot of insights that you otherwise will find hard to do, and it will make you a better investor in a long term. The feedback of this community has been excellent. Simply go to my channel, press on join button and be my guest. With that, let's get this video cracking. First, let me speak about Nifty India Railways PSU Index. So basically, this index is going to track 2 types of companies. Number 1 is core stocks. What do we mean by core stocks? So any company that is part of Nifty 500 and is owned by Ministry of Railways is defined as core stocks. So this index is going to allocate 80% of its weight into the core stock. Second type of stocks are non-core stocks, meaning any company that is part of Nifty 500 is a PSU company and is catering to Indian Railways is classified as non-core companies, and these non-core companies are going to have 20% weightage in this particular index. So as of now, there are total 14 companies that have been included in this index. The list of these companies is on your screen. Now out of these 14, if you look at the top 10 companies by the weightage, we will find that Indian Railways Finance Corporation Limited IRFC is 19.35% of weightage in this index. RVNL is around 17%. IRCTC 17%, and so on and so forth. But one thing you will note here is, for example, Bharat Electronics Limited. It is a non-core company because it is not a railways company. This has been included in the index because it is catering to the Indian Railways and it is a PSU part of the Nifty 500 companies. Therefore, it fulfills the non-core criteria. If I speak about the sector allocation of this particular index, you will very quickly note that 25% of the weightage is to the construction because railways is considered a construction sort of a sector, while financial services hold around 19%, consumer services 17%, power 6%, services 15%. So it is very diversified from a sectoral perspective. Railways is a theme that caters to many sectors. Hence, you see this diverse allocation to different sectors. So these are some basic details about this index. It is a very important index if you ever want to compare and understand what is happening in the railway sector. So please go and do some further research on this, while I will speak about 2 to 3 individual stocks stocks so that I bring you the latest and greatest from what's happening in these companies. The first company that I want to discuss is IRCTC. It's a monopoly company, monopoly stock, and the information that I'm going to present to you in the next 3 to 4 minutes, you are not going to find that very easily. So please make sure that you are not dropping off in between this commentary. The first point is that in the last 5 years, this company's sales has been compounding at around 17% CAGR, which is a very good growth rate in my view. If I look at the profits, even better. So in the last 5 years, the profits have been compounding at around 21% CAGR basis, which in my view is a very healthy growth rate. But the biggest thing you need to understand is that IRCTC's business model is changing a lot. For example, in 2022, if you look at the revenue contribution, internet ticketing was the lion's share. 54% revenues were coming from here, catering 27%, travel and tourism 10%, packaged drinking water, rail near only 9%. Now see what's happening in 2024. First of all, the catering business is the one that is driving the growth. The revenue contribution has gone up to almost 45%. Huge growth and huge profitability coming from catering sector. Second one is the travels and tourism that has gone up from 10% in FY 2022 to almost 16% in FY 2024. Now why catering business all of a sudden is growing at a very fast rate? There are two reasons for it. You need to understand that. Point number one is that their e-catering business is growing at a phenomenal rate. You can see the numbers in terms of the average meals booked per day. If you see from the last 10 years, it has now come to 55,000 of average meals that are booked per day. The growth is humongous. If you compare the last 2 to 3 years of data, the data is in front of you. And the main reason for this e-catering business is that IRCTC has recently lapped on the growth of Zomato and Swiggy. They have done the collaborations between them. As Zomato and Swiggy grows, and as more and more people in railways need the premium service, which is that at their seat, they're going to get food delivery by Zomato or Swiggy or whoever it is, that is where their profitability will be. That is where the next leg of growth is likely to come for IRCTC. The second reason is even more important concept that you need to understand, which is premiumization in Indian consumption. So for example, in IRCTC, what is happening right now is that Vande Bharat trains, which is considered as a premium trains, and therefore they are driving the growth in the catering sector for IRCTC. And as per the latest data presented by their management, premium trains like Vande Bharat are driving almost 1,000 crores of revenue into the catering sector. And it is just the beginning, because we only have, how much? 51 Vande Bharat trains for now. In the next 5 to 10 years, imagine the type of premium trains that are going to come in India. For example, Amrit Bharat trains, they are also considered premium. 1,000 of these type of trains are going to be launched in the next few years. So therefore, the next leg of growth is likely to come from the catering sector. I'll speak about the travel and tourism in a minute, but I just want to come back to the internet ticketing system, which is a cash cow sort of a business segment for them. Why do I say that? Have a look at these numbers. You will see the segment revenues from internet ticketing in H2 2024 was around 70,000 lakhs. And look at the profitability coming from this sector. So if you look at the profitability, it is around 57,000 lakhs. If you calculate the margin, it is 81% margin, because to put an internet ticketing system, it was a one-time sort of a capex sort of a cost. Now on an ongoing basis, if more volumes are coming onto IRCTC's website, they are going to continue to make more money. This is a cash cow sort of a business. That's why if you see the total interest income this company has been enjoying. So for example, in H1 2023, it used to be around 6,000 crore, went up to almost 8,600 crore. This interest income is coming from where? This interest income is coming from the cash that the company is generating, and this cash is being invested into various instruments. That is giving the interest income. That's why I say internet ticketing for IRCTC is a cash cow. Not many people are able to understand this sort of analysis. So if you're liking this analysis, I request you to hit the like button. While I move to the third important point, which is the travel and tourism, have a look at my data. You will see that in H1 of 2023, the first half of 2023, the company was making losses of 3,200 crores. In H1 of 2024, that has turned into positive 631 crores of profit. In fact, if you ask me in FY21, how their travel and tourism business segment is going to do, I would have been very pessimistic about it, because the profitability was not there. In 21, there were losses, 133% losses. FY22, 29% sort of a losses. Now this has also turned a net positive business. So all the four segments are firing right now for IRCTC from a business growth perspective. If you also look at their shareholding pattern, you will find that it is not a heavily FI dominated sort of a company. 7.45% of stake by FIs in December 2024, but DIs have been continuously buying this stock from March 2022 onwards. 5.22% stake have gone to almost 13.73% stake because of the growth that we are seeing in the segments that I've just spoken about. If you look at the last 5 to 6 years of PE ratio of the company, median PE is around 68. Right now it is well below the median PE. Again, I don't know when you're watching the video. Please go and have a look at the PE ratio at the time of watching the video. If you look at the PB ratio as well from a valuation perspective, last 5 years the median PB has been around 25. It is well below the median PB ratio as well. Again, I'm not at all saying that you go and invest in this company. What I've done is brought you insights from where the growth is coming from and where is their cash cow business, which is the internet ticketing system. If you like this analysis, hit the like button. Let me know in the comments. A simple thank you. It motivates me to come up with such content for you at zero cost. With that, let me move to very quickly stock number 2. The second company that I want to very quickly speak about is IRFC, Indian Railways Finance Corporation. A lot of you have questions. Why is this stock all of a sudden become very boring, very dull? What is actually happening? So I'll give you the key insights about this company. What you see on my screen is the disbursements number. This is a financing company. It provides finances for Indian Railways, right? We all know that. But what you will note here is that in FY21, the disbursements hit the all-time high of 1 lakh crore. But since then, it has been consistently coming down. In FY22, it came down to 59,000 crores. In FY23, 32,000 crore. And more importantly, in FY24, the company did not disburse any loans. In H1 FY24, no disbursements at all. That is the main reason that the growth of the company has been flattened out in the last 6 to 8 quarters, because the disbursements are not there. Why the disbursements are not there? If I were to explain to you, it is going to be a full video in itself. So I'm not going into the details of it, but please understand this financing company heavily relies on the money that is needed by Indian Railways. If for whatever reason Indian Railways is not needing the money, then this company cannot disburse more and more fund. But here is even more interesting fact that you need to know. Very recently, in October 2024, IRFC appointed Manoj Kumar Dubey as the new CEO and MD for the 5 years. And I was reading about what Manoj Kumar Dubey has been seeing in the earnings call. And what he said is that they're trying to diversify and they are also going to look beyond just the Ministry of Railways or Indian Railways. They're going to look at those companies that are integrated with Indian Railways. So for example, NTPC, it caters to Indian Railways. And very recently, they did a 700 crores of a financial lease agreement with NTPC. This is a very positive news. Also, just yesterday when I was reading their Q3 2025 results, I found that they are the L1 bidder, which is the lowest bidder in particular segment for another project which is around 3,000 crores for the development of coal block in Jharkhand. Again, seems like that they are going to diversify, and when they diversify, their margins are likely to also improve. So all in all, IRFC's growth heavily relies on how much they can diversify, because they are heavily reliant on Indian Railways budget. Budget 2025 is few days away. Depending on how much of budget is allocated for Indian Railways, the growth of disbursements might pick up. Again, we don't know what is going to happen, but what we can see right now is that the stock has been in a lull period, mainly because of no disbursements that we have seen in the last 6 to 8 quarters. Things may change rapidly, and that's why if you see the Q3 FY25 results, you will note that the profit growth is only 1.98%. That is a very low profit growth rate. It all depends on the budget allocation that happens, and secondly, the diversification. If you go to their shareholding pattern, you will find something very interesting, that FIs, DIs have not really heavily invested in this company. Is that a good sign or bad sign? I think it really depends on your investing style. People who are high risk taker and can identify stocks that have low FIs and DIs investments, they bet on the fact that in the future, if the growth comes, FIs and DIs will buy, and that might take the stock prices up. On the other hand, there are investors who think that, you know what, FIs, DIs have limited investment in this stock, maybe I should better keep away from this stock. Both type of investment styles do exist, depends on type of investor you are. But this is the main reason for why IRFC has been under pressure in the last few quarters, because of no disbursement. I hope you found that very insightful. With that, let me move to my third company. The third company that I want to speak about is Titagarh Systems. The reason I'm picking Titagarh Systems is because it is a private company. The last two companies that I spoke about were PSU companies. So maybe it's time for us to add a private company into this conversation. Now, this Titagarh Systems is a FI driven stock, and there has been a huge selling in FIs that we know in India in the last few quarters. Why do I say it is a FI stock? Let me now give you data points. So what you see on my screen is that you will note from September 2021 to March 2023, the sales of this company has been consistently growing at a very, very good growth rate. You can see that from 342 crores, it's gone to 974 crores. But what you note is that from June 2023 onwards, the growth in the sales have been very, very flat. You can note that, right? However, in spite of that, what happened in the stock prices is something very, very amazing and interesting to note. So from June 2023 is what you need to note. The sales have been flat. But if you note the stock prices from June 23 onwards, up until June 24, they went like a rocket. Now, what happened between June 23 and June 24? If you look at the shareholding pattern very quickly, you will note that FI's stakes went up from 7% to almost 19.56%, meaning that FIs were heavily buying this particular company in that period where the flat sales were there, right? That's why I say this is a FI driven stock. What happened since September 2024 is that FI started doing heavy selling in Indian stock market. As a result, the stock has been under huge pressure. You can see the FI stake have come down from almost 19% to almost 13%. Now you may have a natural question that is the company doing badly? I don't think so the company is doing badly. For example, let me now again give you some data points. So back in September 2022, the order book of this company used to be around 10,000 crore. Have a look at the order book in September 2024. After 2 years, the order book is now 12,000 crore when it comes to coaches or the wagons that the company make. But if you also look at their joint venture share, it is around 13,000 crore. Now you may say that, Rahul, the order book looks very, very high. Why is that it is not turning into revenues and profitabilities? I'll tell you why. The main reason is that their joint venture share order book that you see 13,000 crore, it is made up of two parts. Number one is the Vande Bharat trains. Number two is the wheel sets that they have a joint venture with Ramakrishna Forgings, right? This particular order book is not materializing into revenues yet. Ask me why. The reason is very, very simple, that if you look at the Vande Bharat, they are going to deliver their first Vande Bharat train by December 2025 in Bangalore. And in fact, the revenues will start to flow and make some meaningful dent in FY 26-27. So we're still far away from seeing these order books getting into the revenues. That's why you will see the order book is very, very high, 13,000 crore, but the revenues have been flat because right now the main revenues that are coming from making the wagons that they already have the orders for. Second is coming to the Ramakrishna Forgings, the wheel set business that they have. Again, huge order book there as well. They are going to start manufacturing it from 2025 onwards. So this commentary was in 2024. Next year means 2025. So hopefully some point in time during this year, they are going to start manufacturing these wheels, start to deliver them. It will start to note in the revenues as well. Therefore, there is going to be some time for them to see this order book getting into revenues and profitability. But people want immediate returns. That's why when they see the flat revenue growth, they don't understand what is really happening. My intent is to bring you these insights on this channel so that you are understanding what is actually happening and make some informed decisions. Whatever you want to make informed decision is up to you, but I bring you insights. And if you like that, hit the like button. Let me know in the comments a simple thank you. It motivates me to come up with such content for you at zero cost. Also, I do not speak enough about subscribing to my channel. So here I am requesting you to subscribe for the channel. You are going to learn a lot. That is what I can guarantee. Now, please do not take any of these stocks that I've spoken about in this particular video as recommendations. These are not buy sell recommendations. I've brought you insights. I've brought you some meaningful information that will definitely make you a better investor, informed investor, and a smart individual. With that, I hope you enjoyed this video. If you did, press the like button. I'll see you in my next video. Until then, keep rocking.